Okay, I think we've got a fair few people joined now. So good morning, everyone. Thank you for joining us today for the Alliance Trust Investor webinar. My name is Tom. I work in the investment trust team here at Kepler Partners. Just a quick bit of housekeeping. All attendees are muted, but if you'd like to ask a question, you should be able to see the Q&A function on your screens now. Please feel free to ask any questions you like, and then at the end, we will answer them after the presentation. So the format is going to be a 30-minute presentation, followed by up to 30 minutes for questions and answers afterwards. As you guys may be aware, Alliance Trust is one of the largest and most widely known global equity investment trusts, and has been managed by Willis Towers Watson since 2017. On the call, we have myself, Maria Michiela from Willis Towers Watson, Mark Atkinson from Alliance Trust. We also have Stuart Gray, who will be giving the presentation, who sits on the investment committee at Alliance Trust. So I'll now hand over to Stuart to go through the presentation. Thank you.
Great, thanks very much, Tom. Thanks everyone for your time and interest in Alliance Trust. So the goal today is just to tell you a little bit about who we are, what we do, and what the investment proposition is to you as investors. So we'll get straight on with the presentation. First, a little bit about who Willis Towers Watson is. Simplest way of describing us is we're a large global investment management firm. We run about $180 billion of capital for large institutional investors around the world across all asset classes. So primarily we work with pension funds, but also sovereign wealth funds, endowments, foundations, and the like. So as well as running money for them, we're also advising, providing investment solutions to large institutional investors. And you can see we've got over $3 trillion of assets that we might be offering advice to at any point in time. So I think the key point is that we're a large global firm with a lot of institutional expertise, and we're trying to help some of the most sophisticated investors around the world invest their capital. Really the purpose of partnering with Alliance Trust, and when we first talked to Alliance Trust about what we could potentially do for them, it was about bringing some of these institutional expertise to the UK retail marketplace. So I'll move straight on to what the proposition is that Alliance Trust is offering investors today. As you and I well know, there's lots of things that you can invest in, and there's plenty of funds out there. There's lots of opportunities to invest in different funds. We had no interest in just coming to the market with, here's another fund that you can invest in, which looks like everything else. Alliance Trust is very keen to offer everyone something different. And that's why they appointed Willis Towers Watson to sort of bring this sort of institutional knowledge, to bring something different to the UK marketplace. So these are the main pillars that we use to describe how our approach is different to most things you can find out there in the market. So it starts off with high conviction. What we're trying to do is maximize long-term returns, improve people's investment outcomes from the equity markets. And we do this by having high conviction portfolios. These are customized, concentrated portfolios of 10 and 20 stocks. The reason we do this is we think those portfolios maximize the skill that actual equity investors have, which is analyzing businesses and picking stocks on your behalf. 10 and 20, I think, is the right number, 10 to 20, because we don't ask investors to pick one stock, because we know that people aren't perfect. You're never certain that you get any decision correct. So picking one stock isn't the right thing to do. Equally, by the time you pick 30 or 40 or 50 stocks, you're diluting how much skill you have in making those selections. How good is your 50th best idea? 10 to 20 stock portfolios is the real sweet spot for maximizing the skill and return expectation you can have from portfolios. The next thing is risk control. These 10 to 20 stock portfolios we think are better, but they can be more volatile in the short term. So we manage portfolio risk by having lots of these portfolios together. We have 10 of these managers in the portfolio today. That gives a lot of benefits of diversity, and it helps investors have a smoother path of returns, so they can hold this investment for a long period of time. And of course, Alliance Trust, the strapline, of course, in the bottom right logo actually is investing for generations. We want Alliance Trust to be a portfolio that you can hold to compound your wealth for you and your family over very long periods of time. And having a risk control portfolio enables you to do that. The next pillar, exclusive access. Obviously, we work on a global basis. We've got access to investors all around the world. So we can bring investors to the Alliance Trust portfolios that you wouldn't necessarily be able to access yourselves in the UK retail space. And hopefully that's an attractive proposition. Then it's dividend growth. So we know that investors do like to have dividends. Progressive dividends is key. So Alliance Trust is an AIC dividend hero. It has been raising its dividend every single year for the last 54 years, and it fully intends to do that going forward. So it's a reliable progressive dividend that can give you a reliable income through time. The fifth pillar is sustainability. Everyone talks about ESG today and sustainability and climate change. It's clearly an enormous topic. There's lots of information, some misinformation, lots of noise, and it's quite hard to understand what's going on. Again, coming back down to Alliance Trust being investor for generations, if you have that time horizon, you have to think about investing in a responsible manner and owning companies that are improving and delivering sustainable returns to their shareholders. Where we think there are risks in the portfolio, we will engage with companies to try and improve the portfolio and reduce the risk and improve returns over time. Finally, it's low cost. We do think we can deliver a better investment proposition. So all of the things we've talked about, we think means this is a better investment proposition than you can often find in the marketplace. But we want to deliver it at a cost which is sort of at or below what you typically pay for a global equity, active equity product. So the OCR of the portfolio was 64 basis points. We think is a very compelling cost for the investment proposition that we have today. So I'll just move a little bit quicker through a little bit of supporting rationale for why we think those are the important pillars. Concentrated portfolios. This is important to the proposition, and there's a lot of academic research out there. There's hundreds of pages of academic research supporting the idea that concentrated portfolios improve your chances of outperforming net of costs over the long term. This isn't just based on academic research, though. It's based on our own experience. I've been at Willis Towers Watson for 18 years doing this, and all of our experience tells us the same thing. And of course, it's hard to summarize all of that for you on one slide, so I've just shown one chart. And what this chart is really trying to show is active risk on the bottom axis, horizontal axis, and return on the vertical axis. And what this is really showing is that as you increase risk, you are increasing your chances of delivering alpha net of costs. So by customizing our portfolios to go even more concentrated than typical in the marketplace, we're just pushing out to the right-hand side of this chart, and we're improving our chances of delivering our performance after costs. But of course, it's important to have skilled investors. You don't want a concentrated portfolio in the hands of someone who does not have a competitive advantage. And this is where Willis Towers Watson's global resources and expertise comes into play. We need to find managers that have genuine competitive advantage at running concentrated portfolios and making the right stock decisions. So most investors, when trying to pick a manager, you'd look at the brand name of the investment manager that you're looking at. You'd look at the track record of the particular portfolio or team, and you'd make some decisions. We want to go a long way beyond that. We spend hundreds of hours working with managers, assessing their competitive advantage and their skills. We do this by simply sitting down with them and going through, stock by stock in the portfolio. What are their decisions? What has the research been that they're doing? How do they come up with these ideas? How do they analyze the company? How do they turn those ideas into a portfolio? How do they manage risk in the portfolio, et cetera, et cetera? So we're just going through every single thing that they do and understanding why what they do is better than everyone else. And I think that, again, this comes from experience and expertise, because like I said, I've been doing this 18 years. I've probably looked at more than 1,000 products. You get a sense of which products are just doing the same kinds of things as everything else, and which ones are truly differentiated and offering something above and beyond what most are able to do. So we assess competitive advantage at picking 20 stock portfolios. But on the right-hand side of this page, sustainability is really important, because we want to invest for generations. We have a very long time horizon, and we want to partner with these managers to pick stocks for you for very long periods of time. That means we need to understand the culture of the business. You need to understand the alignment of those people and of the business. They need to be aligned to your interests, which is maximizing returns, not to their own interests of growing their business and making themselves rich. So we want people who are totally focused on return generation and who are working in a culture and business environment that is conducive to making long-term investment decisions. So we have lots of frameworks for assessing the sustainability and stability of an investment organization. And that means we can filter a huge universe. So as you know, there are thousands of products out there that you can potentially choose to invest in. We've got more than 15,000 in a database. We've done due diligence, like detailed due diligence on several thousand of those. Out of that, only 200 or 300 or so get our top rating, a rating that we think means that they're truly differentiated. But to filter that larger universe down to a few hundred means that you've got to know what you're looking for. And that's what I just talked about on the previous slide. Finally, out of the few hundred products which we think are genuinely interesting, there's about 20 or so, maybe a few more today actually, that we rated as very genuinely skilled at running concentrated portfolios, because that's not a skill set that everyone has. Not anyone can run a concentrated portfolio that has sort of the risk profile that they come with. It is a particular skill set that you do need to spend a lot of time assessing. So there are 20 or so today that we rate very highly. And of those 20, we select 10 for the Alliance Trust portfolio. I'll maybe talk more about this later on, but how we pick 10 out of the 20 or so that we have, we're looking to find those 10 which fit best together in a portfolio, that maximize our diversity. And that means we're looking at people that think very differently to each other. So all of these managers are trying to do the same thing, invest in companies and generate returns. But there are lots of different ways of doing that. And if we have people who think very differently about the problem, it means that they're going to outperform and underperform at different times in the market cycle. It's going to give us diversity of ideas, diversity of styles and characteristics, and it's going to give us diversity benefits in the portfolio. It's going to reduce our risk in the short term, and that's beneficial. So to try and explain what that actually turns into, this is a messy looking chart, obviously, but what we're trying to show here is the performance of Alliance Trust relative to the market is the purple line through the middle. So that's outperformed by 1.1% over time. But the grey squiggly lines are all the individual managers. So what this is showing you is that these concentrated portfolios, like I said, are very volatile. They go up and down a lot, and they can deviate a lot from the benchmark. Of course, the benefit of us putting lots of managers that think differently together is that they perform differently. So you've got some doing very, very well, some are struggling in this particular market environment. And again, very, very simply, the last few years you could categorize as being dominated by large cap tech growth companies, would be a simple explanation. So the managers that we have who are focused on growth investing generally done very well. Managers focused on value investing have been struggling. But there are times when that will change and reverse. An example of that, if you can see it, is from September 2020. If you look at the bottom of the chart there, the underperforming managers. Those are the value managers, Lyrical, River, Mercantile, Jupiter in this portfolio. Clearly been struggling as growth was in favor, value out of favor. But from September 2020 to June 21, they were the best performing managers in the trust. Value rallied very significantly. And that's why having a balanced portfolio of lots of different managers means that you are protected when the market rotates very significantly in a short period of time. Sorry. Okay, so here is the portfolio today. I mentioned a couple of the managers, but we have 10 managers in the portfolio. I've tried to describe very simply their styles on the right-hand side, but again, it's about making sure that these managers are different in what they do. And this is how we put them together in the portfolio. So you can see in the pie chart roughly the allocations. They're not perfectly equally weighted. we do sort of adjust the weightings. We like to give a fairly even amount of capital to each of these managers because we think they're all very skilled at what they do. But Willis Towers Watson is looking at the portfolio, and we will adjust the capital allocation to these managers in order to balance the overall portfolio risk. So that's what Willis Towers Watson is doing. It's managing the overall portfolio exposures and making sure that it's the stock selection of the managers that is really driving the returns. And then just to give you a really quick example, let's take SGA on the left-hand side there. So SGA stands for Sustainable Growth Advisors. The clue is in the name. They are looking for sustainable growth companies. So these are good quality businesses, strong barriers to entry, dominant products or some sort of intellectual capital or some product which gives them unique advantage and a strong business moat and barriers to entry, like I said. Those types of businesses are capable of growing quite rapidly or for sustained periods of time. So those can be quite attractive investment opportunities. And on another side, so let's take Lyrical Partners. Excuse me, Lyrical, more of a deep value manager. They are looking across the market, they're looking for the cheapest companies in the marketplace. Bottom decile of valuations, basically. Now, a lot of those companies are going to be very cheap for a reason. So they're not looking to buy loads of them. They're looking to buy a concentrated portfolio of just a handful of those companies that are completely misunderstood by the market, because those are the businesses that are good quality companies that can actually grow their earnings and are resilient, but the market has, for some reason, discounted that and made them very, very cheap. So they're looking for effectively diamonds in the rough, trying to find those companies that have been overlooked by the market, but actually much better quality than they thought. So two completely different types of investment processes, very unlikely to ever buy the same kind of company. SGA looking to buy companies that are high quality, firing on all cylinders, growing very fast. Lyrical is looking for very cheap companies that the market thinks have serious problems, but actually don't. Both can give you very significant returns in the long term. And sort of that gives you an idea of how we put this portfolio together to give you diversity of ideas and balance in the portfolio. Very quickly, we talked about sustainability and that being a pillar of what we do. Very simply, when you're investing with a generational time horizon, you have to be thinking about these risks facing the companies. Now, every single company today is facing some risk regarding ESG. Obviously, there's a lot of focus on climate, but it's also social issues, governance issues, and so on. We integrate this into all of our research processes, and we expect the managers themselves to also integrate it into their research processes. The goal is to assess these risks and value them, understand what is an acceptable risk, what is not, and what risk is mispriced. Because ultimately, we're trying to take risk to generate return. So this is not an impact fund or something which says any kind of risk is bad. We are assessing these risks and thinking about where there's opportunities. So all these managers will have policies around how we manage risk in the portfolio, where there are companies that are not perfect, because no companies generally are perfect. We're looking for managers to engage with those companies, work with them to improve over time, and that will again help reduce risk for those businesses or potentially generate return opportunities. We also make sure that we're voting on all the proxy votes. So we're voting at all the AGMs for these companies, and we demand transparency from the businesses and also from our managers so we can see what's going on in the portfolio. And in the same way that we ask managers to engage with companies, we engage with our managers. So if we think our manager is falling behind in some aspects, we will engage with them to try and make them improve. And of course, that should be the case. But if it were not, and if we engage with the manager and saw no improvement, that's the kind of thing that would make us reassess and potentially change that manager. On engagement, over and above what we do, we employ a company called EOS at Federated Hermes. So I think that the reason we do this is because with the best will in the world, no manager has infinite resource. So Willis Towers Watson is doing a huge amount in terms of engagement on ESG. The underlying managers, the 10 managers of Alliance Trust, they are also engaging with companies on ESG issues. But EOS at Federated Hermes, EOS stands for Engagement Ownership Services, Equity Ownership Services, excuse me. EOS is additional resource over and above what any of our managers have. It's dedicated resource to these engagement activities. And they do this on behalf of a lot of clients around the world. So they represent clients that have $1.3 trillion of assets. So what EOS can do is turn up at a company, knock on the door and say, we represent a large part of your shareholder base, and these are the issues that we think you need to be focused on and improving. It's a very powerful way of doing some engagement work, and it's an additional benefit that Alliance Trust can give its investors over and above what any of the managers can do, and what you would typically be able to buy in another fund that you might purchase from a manager. So what EOS does, it's engaging on climate change particularly, also executive remuneration, human rights, cybersecurity, other labour issues, and all sorts of social issues. Again, one of the benefits of Willis Towers Watson and our involvement is we sit on the client advisory board at EOS. In fact, we chair it. So we have some input into what their engagement priorities are. So not only are they engaging on your behalf, we can help set the agenda for what those engagements should be. We talked about the dividend. So 54 years of increasing dividend. That's one of the longest in the sector. As I said, it's an AIC dividend hero. Of course, Alliance Trust is very proud of its long heritage and, of course, its record in doing this. And the board is very much committed to continuing the progressive dividend policy. So I think what we've learned from shareholders is that they do value dividends, so the level of dividend income itself, but also the progressive nature of it and the reliability of it growing through time. Just recognizing the first point, though, that the board has decided to have a reset the dividends, to have a step increase in the dividend payment to make the dividend level a bit more attractive. So for investors seeking income, it will have a higher level of income going forward. But again, the dividend policy is to make that a progressive dividend, so to be able to grow that dividend every year through time. And finally, on costs, I said we wanted to deliver what we think is a compelling and attractive strategy, but at a cost which is sort of similar or below what you would typically pay for an active global equity fund. And here we've just shown the KID costs of a variety of companies in the sector. I won't go through them all, but you can see Alliance Trust, if you've got good eyesight, towards the right-hand side of that chart. So again, Alliance Trust, compared to competition, is a relatively attractive level of fees for what we think is a superior investment proposition. Just very quickly in terms of performance, there's lots of numbers on this page. We're showing the shareholder return, total shareholder return at the top. Then we've got NAV return, and then we're showing the equity portfolio total return in the third line. That's compared to the benchmark MSCI ACWI on the fourth line. I'm just going to focus quickly on the equity portfolio return, first and foremost. So that the equity portfolio represents the assets of the trust today. Since our inception, the equity portfolio has outperformed 65.8% per annum absolute since inception. So it's been a very, very strong period of equity returns, and the portfolio has performed very well. So very strong absolute performance since inception. On the right-hand side, you can see that since inception, that's ahead of the benchmark by 1.1%. So clearly, we're pleased that we're ahead of markets, even though markets have been incredibly strong. It's worth saying that we all know, and studies have shown that around 80–85% of active equity products underperform net of costs in the very long term, so over rolling 10-year periods. So encouraging that the strategy is working, and it has outperformed in the sort of 4 and a bit years that we've been managing it. To be perfectly honest, we expect to be able to outperform by more in the long run, and we expect to be able to do so going forward. And part of the reason for this, if you look at the bottom row, the MSCI ACWI equal weighted portfolio, so that's exactly the same stocks as the MSCI ACWI, but equally weighted instead of market cap weighted. And if you look at it since inception number, the equally weighted portfolio has underperformed very significantly the market cap weighted benchmark. So that just shows you how dominant the large stocks in the index have been. And ultimately, if you were picking stocks at random, if you like, across the market, you should expect to have underperformed by a lot. So, clearly the stock selection of our managers has been good, and the portfolio construction has been good. So the portfolio is ahead. But I think if that sort of headwind were to subside, there's a lot more potential to come through from the stock selection skill that we have in the portfolio. Very briefly, the NAV return is a little bit below the equity portfolio return, and that's because of the historical situation. When we took over the trust in 2017, there were some legacy assets, non-core assets, which have now been disposed of. So some unquoted, or some fixed income, and some mineral rights, and some private equity. So those have been largely disposed of, and the portfolio is now 100% global equity portfolio. Very quickly, the discount. I think the main message on this slide is just to say that the top chart is showing the discount since our inception in 2017. The discount's been pretty stable. You can clearly see a spike around the COVID pandemic of March 2020, but ultimately the discount has been pretty stable. We do think that, as I said, the proposition is compelling, so we're trying to talk to investors more about the attractiveness of what we do, and hopefully the income that we talked about before and the dividend should help get investor interest. And over time, we would like to see the discount come in, but the message, I think, is that historically the discount has been pretty stable and remains so today. Finally, I guess to sum up, the benefits of our approach, just a reminder that what we're trying to do is bring a different way of running global equities portfolios and bring an attractive proposition to investors. So this is a multi-manager approach. We think it's better than a traditional single manager approach because there's more diversity in the portfolio. We think stock selection skill is going to drive returns, and you're not wedded to the single style of a single investment manager. And as we all know, those styles can go through periods of being in favor or significantly out of favor. So the diversity that the portfolio offers, we think, is much better than a single manager approach. But on the right-hand side, we think it's better than a typical multi-manager approach because we're doing things differently. We are using these customized high conviction portfolios. We are trying to deliver this at low cost, like I said. So we're trying to make better returns, lower costs, and with that, you get all the integration of sustainability and the customized portfolios and everything that we talked about in terms of what we do. So that is all I was trying to cover today. Hopefully that gives you a good idea of who we are and what we do and why the Alliance Trust proposition might be an interesting one for you. I'm going to stop there and see if I can see we're getting quite a few questions in. Actually, that's helpful, so thank you for those. Please do submit any more questions if you'd like to. And maybe I'll hand back to Tom to take us into the Q&A.
Perfect. Thanks, Stuart. Very thorough presentation. And as you mentioned, we've got a few questions, so I'll ask them to you now. So the first one we've got: do you adopt a thematic approach when determining which managers or areas to invest in?
So it's an interesting question. I think the main point we'd like to make is that we want diversity. So we're not trying to put all our eggs in one basket, because then you're going to be subject to the swings, pros and cons of that basket, if you like. So we want diversity of thought, and that's why we have this multi-manager approach. However, within that, each individual manager is certainly going to be focused on a few key investment themes. So a number of them will be, some of them might be focused on semiconductors and Internet of Things. Others might be focused on recovery in some European industrials or something like that. So they will be running individual themes that they find very compelling at a particular point in time. But the overall portfolio is giving you a lot of diversity and doesn't want to take too much risk on any one particular bet.
Okay, perfect. Thank you. Next question. Do you ever introduce absolute return managers into your portfolio to protect against drawdowns?
Yeah, this is an interesting question, because we are trying to maximize long-term absolute total returns. And by virtue of giving these managers a concentrated portfolio of 10 or 20 stocks, it's very hard for them to think about managing benchmark risk with only 10 or 20 stocks in the portfolio. This is very much an absolute return stock picking approach. Now, Willis Towers Watson can think a little bit about market relative positioning when we construct the entire portfolio, but the individual stock pickers are focused on maximizing those absolute returns. So I think that's actually a benefit of the approach. We're not, managers are not putting in stocks to be fillers or to be risk control positions. Every single stock in this portfolio is someone's very best idea for generating absolute returns. And I think that's one of the key drivers of the proposition.
Thank you. Next one. Do you react to macro concerns or maintain conviction?
So we don't try to take macro views. I think the key point here is if you're trying to generate returns by making one or two decisions on big macro factors, that's not a very good way of generating long-term success, because as we all know, the chances of getting any decision correct is certainly not 100%. Even if you're incredibly skilled, you might get 60 or 70% of your decisions right. So if you only make one or two decisions on one or two key macro themes, the chances of it going wrong is actually quite high. So like I said, the portfolio has diversity. It's designed not to take big macro bets. It's designed to generate returns through lots of idiosyncratic stock-specific calls. And that's really what we're trying to do. So I would say we don't really overreact or react to big macro calls. And clearly we're cognizant of managing risk in the portfolio. So we do adjust the portfolio through time as the market evolves. But we're not making big reactions to single market macro calls.
Okay, perfect. And perhaps on that, how will the portfolio hold up whilst interest rates rise?
Yeah, so I think the key thing here is that we've seen quite a bit of change in the market in the last 12 months. And we haven't had an awful lot of change in our portfolio. So the portfolio is designed to be robust in different market environments. So when the market goes through a change, like we saw from, say, November through to, I guess, May or June of this year, that was a very inflationary type period. Economic recovery, markets were going up. People were excited about inflation coming through because it meant market recovery. So that was a very strong period for value and cyclical companies. Since then, people have been worried about inflation. We've had supply constraints, supply chain disruption, etc., high energy prices. So people are now worried about inflation, and that's changed the market environment again. But because we have a variety of managers in the portfolio who will benefit from different types of environments, the overall portfolio doesn't need to change much and is pretty resilient to those events. So I think we're quite excited about the portfolio today. I think we've got a lot of compelling opportunities in the portfolio. So even in a rising rate environment, I think the portfolio is quite well positioned.
Perfect. Do you worry about geographical diversification, or are your managers always global?
So we always give them a global opportunity set. If you've got a manager that's skilled at analyzing a business, it doesn't really make sense to us to constrain them to a particular part of the market. That said, there are some managers who prefer to focus in particular areas, and that might be by geography or it might be by a certain theme or characteristic. So one manager, Lyrical, for example, I mentioned earlier, they tend to stick to US companies. Again, at the overall portfolio level, we make sure that the portfolio as a whole has got opportunities coming from all different geographies, sectors, styles, and so on. So yes, we make sure there is a global representation in the portfolio. And each individual manager, we give them a global opportunity set generally.
Okay, great. How far away would you go from the MSCI ACWI? And another part of that question is, would you ever look at smaller companies or unquoted assessed bright equity?
Yeah, so I think let's just say straight away, unquoted, we don't have any and no intention of doing anything unquoted in the portfolio today. It's a listed global equity vehicle. So no plans to do that. In terms of what we do in listed equities, it is an unconstrained approach. So we have an all cap approach. So we can have small caps in the portfolio. We do. We have small, mid and large cap companies. Again, back to this point around, if you've got a skilled manager, why constrain them to say you can't buy a certain type of company? There's a practical reality. Alliance Trust is a large investment vehicle. It's a £3.5 billion, roughly speaking, investment portfolio. So it doesn't have very, very tiny companies in it. There's a perfect amount of liquidity in the portfolio, but we do allow managers to go across, small, mid, and large cap. Whereas the benchmark itself is typically a mid-large cap type index. So we have a portfolio with characteristics similar to the benchmark in terms of geography, style, sector, and so on. But our stock picking is pretty unconstrained.
Okay, great. How important is diversification in your team and your managers?
Yeah, very. So we've talked about diversification quite a bit. I mean, looking at just the questions here, we could do this a few different ways. I said at the start, the reason we have 10 or 20 stocks rather than just one is because we do want diversity in the manager's stock picking. And the reason we have 10 managers and not just one is we do want diversity in our portfolio of manager selection. So there's a lot of diversity built into the portfolio by design, and that's a good thing. I would also say, whilst we mention the word diversity, I mean, we also think about diversity from a team perspective, cognitive diversity, and how we get different ideas into the portfolio. So we also think a lot about that in terms of the teams themselves and the culture of the organizations. So at every stage, we're trying to find diversity. So.
Perfect. Slightly long question here, so bear with me. Seems like a key factor on overall performance is the choice of 10 themes or areas to invest in. How do you choose those? And also, how do you manage and track the risk of making poor selections? How often do you review or change your managers? A couple of things to work on there.
Yeah, good. So we've got 10 managers. Does that mean we've got sort of 10 themes or areas to invest in? And how do we pick them? I would say we don't start off with having 10 boxes and saying, how do we fill these 10 boxes? i.e., a large cap growth box and a small cap value box and so on, and then trying to find a manager to fit it. That's not what we do. What we're trying to do is just find managers that are somewhat unique and have a competitive advantage of what they're doing. And remember, I talked about having thousands of managers out there. Finding someone unique in a world of thousands of managers where lots of people are roughly trying to do the same thing is not that easy. So we're just trying to find people that are different. And then once we've found people that are skilled at what they do, then it's a case of just putting them together such that we've got a portfolio of people that think differently and do things differently. So I don't have to choose what are the things that they do. I just have to make sure that we've got enough people that think differently and do things differently that when we have them together, it works. But I think you're right. In reality, if we ended up with two managers that are both focused on, for want of a better phrase, why don't we just say, focused on growth opportunities, and they were all buying US tech companies in the last few years, and essentially they looked like they were doing the same thing, then we wouldn't need both of them in the portfolio, ultimately. We'd want to find someone else. And then you talked about what's the risk of making a poor selection and how often do we review and change it? So there's certainly a risk of making a poor selection. And as I said, no one gets 100% of their decisions correct. So we expect all of these managers to outperform very significantly in the long term. The reality is probably not every single one of them will, but most of them should. So we're constantly reviewing all of our managers. And what's important is that we don't assess their skill really on short-term performance, because as we all know, short-term performance can be very volatile and it doesn't really tell you whether a manager is skilled at picking stocks for the long term. So it's back to the process I described earlier, which is going through all of their stocks, all of their investment decisions, all of their research, thinking about where they're making behavioral mistakes. Are they getting things wrong? Are they getting caught in traps? Or are they generally making good decisions, but the market just hasn't agreed with them yet? So we will make changes to managers, and we have made a few changes in Alliance Trust. Typically, it's when we think the manager isn't executing the process in the way that we expected them to, or in a skilled manner that we thought that they had. That's when we'll typically change a manager.
Okay, great. And a question on fees here. So the cost ratio is 65 basis points. Does that cover the fees and costs of the underlying managers as well as the fees and costs of the trust?
Yes, so that OCR number includes everything, all the costs. So it's Willis Towers Watson fees, it's the underlying managers' fees, it's EOS at Federated Hermes' fees, it's the costs of running the company itself. Everything should be in, all those fees are in the OCR.
Okay, perfect. I think that's all the questions we have. A couple of people just mentioned, will there be a recording or will we be sending out slides? We are recording this event, and barring any sort of compliance issues, we'll hopefully have this up on the Kepler website, and I imagine also the Alliance Trust website, so do look out for that. In that case, I'm not seeing any more questions coming through. So just leaves me to say thank you to Stuart and the guys from Alliance Trust for being on the call today, and thank you so much to you guys for joining. Hope you found it useful.
Great, thanks everyone. Thanks for all your questions.
Thank you guys. I think that's everyone. I think I've just expelled the last few, which seemed a bit heavy-handed, but left me no choice.
Got them on the collar and shoved them out the door.
Yeah, they've had quite enough. But yeah, perfect. Thanks, Stuart. That was great. And yeah, some good questions coming through. So I didn't feel the need to go through the ones I put as well, but I added a couple in there. But yeah, no, fantastic. I think we
I thought it was really good, Stu. Well done. I thought it was really clear. Yeah, very clear on each slide, and put the narrative together really well. Got across all the key points. I thought it was really good.
Yeah, fantastic. I'll have to check what the last sort of participants were, but I think it was hovering around the sort of early 40s, mid 40s, for pretty much the whole thing as well. Very few people seem to drop out, so that's good.
Yeah.
So there were 2 people from Quill too.
Well, yeah, I saw Sarah.
Stephanie and Sarah, yeah.
Saw a few of our well-known shareholders on there as well. Barry Faith, he writes to me regularly.
Oh, really?
But there's certainly some new names up there. That was great. Well done. We could definitely use that.
Okay, excellent. And obviously we just have to edit out our little chat here again, I guess, before we put on, but perfect. Thanks. And again, I assume you saw my email about the Farley and Thompson meeting.
Yeah.
I mean, I don't know what to say anymore, to be honest. Yeah, I was speaking to Keith earlier, and he's like, yeah, there were 3 people cancel on the day for one roadshow, so that's hugely disappointing. But what I'll do is I'm going to chase them this afternoon and just, I mean, they've all 3 of them have said they, rearranged the meeting, so maybe it's just a case of getting some more time in diary, but hugely frustrating. But yeah, we'll sort that out.
But we've got one more.
Yeah, you got one more this afternoon, Henry, I think. Yeah.
Yeah.
And then we've got a JM Fin one in a week and a bit's time, which is sort of the central research team. So yeah, so maybe if that's a free morning you have around that JM Fin time, maybe we put something around there. But yeah, we can liaise on that bit later on.
Okay.
Thanks, Tom.
Awesome. Well, thanks for that, guys. That was great. So thanks, Stuart. But yeah, we'll catch up soon.
All right.
Cheers then.
Cheers. Bye.
Good afternoon. Bye.
You too. Bye.